Good afternoon, shareholders of CapitaLand Investment CLI. Welcome to Kopi with CapitaLand Investment. This is a virtual dialogue session facilitated and moderated by us at SIAS. CLI will be holding its virtual AGM on 29th of April, Friday at 10 a.m. and would be proposing several resolutions for shareholders to vote on. As time at the AGM is usually constrained, today's session, which is a pre-AGM session, is organized for you, CLI shareholders, to be updated on the company's financials 2021, its performance, business outlook for 2022, and also to address your questions regarding the company and the resolutions proposed. So we have invited the senior management of CapitaLand Investment to join us at this dialogue, and I welcome on my right Mr. Lee Chi-kun,
Thank you,
who is the Group CEO, and on my left, Mr. Andrew Lim, the Group CFO. Thank you, gentlemen, for joining us this morning. And I would, before I hand over, Mr. Lee Chi-kun will start off the session with his opening remarks to shareholders before handing over to Group CFO, Mr. Andrew Lim, who will walk you through the company's performance for financial year 2021 with a corporate presentation. We will also address your questions later during the Q&A session. So please submit your questions via the pigeonhole. Access details can be found in the event confirmation email. So, Mr. Lee Chi-kun, without further ado, could you say a few words, and over to you.
Thank you, David. Hi, afternoon. Very good to see all of you, even though it's a virtual event. It's really been, last more than 2 years before we, when we used to do this physically, meeting people on a face-to-face basis. But 2021 was a very big milestone year in the history of CapitaLand, where we have proposed a restructuring. I believe all of you are very familiar and supported, resulting in the privatization of the development business that all of you used to be a part of. But now, the CapitaLand, it's restructured into two parts. One is the CLD that's 100% owned by Temasek, leaving the asset management, and the lodging management part of the business listed. As you can, we spent a long time, thinking about how to restructure the business, and really want to thank all the investors, for supporting and riding through the journey with the senior team here. First, in 2019 with the merger with Ascender Singbridge, and then trusting us, to navigate through the darkest hours of COVID-19. In 2020 was, to be frank, quite demoralizing to the team, where Singapore was locked down, China was locked down, and we were all concerned about the future of the business. But gradually things started to open up. We were more confident about the business, and then continue to want to restructure the business and to better position it for the future. Well, the restructuring is done. It got relisted. The market has spoken. Share price has done quite well. Unlock significant value for the shareholders. I think that's a good sign. But I want to reiterate that the CLI journey, even though it's relisted as a new entity, share price has traded well, we are not a finished product. We have a good track record on the public REIT space. Our lodging sector, even though we have built up a nice platform, is in the recovery mode. We're happy to see borders reopening, people starting to travel. We are starting to see business picking up. I think it's on a good trajectory. On the private equity fund side, It is an area where we have been investing resources, building it up the team members, and as you have seen, how we have brought in people with experiences from Brookfield and BlackRock to really embellish the capabilities within our team, because we are serious about growing this part of the business. So you will see a lot more activities going forward. In terms of financial results, last year, we're still in the COVID recovery mode, and some of you may remember that we still had to give cash rebates to retailers. But as a whole, I think we still delivered a decent set of financial results, even though we were still recovering from COVID. Strong cash profits, and as a result, we were able to propose a dividend of 15 cents, comprising 12 cents, which is the usual dividend that we used to pay in the old CapitaLand days. And we decided to add on an additional 3 cents of dividend as an additional proposal of 3 cents of dividend to make up for the drop of dividend from 12 cents to 9 cents in the preceding year. So that's largely the picture I wanted to share for my opening remarks. I leave Andrew to take you through a bit more details behind some of the financial numbers before we go into Q&A, so that we can address some of your questions more specifically. Thanks. Andrew, over to you.
Thanks, Chee Koon. Hello to everyone. It's great to be able to speak to you about our first set of results, which I think we have termed a creditable first full year, even though we were only listed in September of 2021. I think Chee Koon's phrasing of us being an unfinished article is absolutely accurate. We've made a good start, as our financial results has hopefully demonstrated to all of you. If I drill down a little bit, I'll spend maybe a few minutes just talking broadly about our financial results and how we perceive them to represent our point of time in the journey that we have ahead of us. We've received a lot of questions from all of you, so I will spend less time on the material, which you have already seen, and then we can dive straight into Q&A and spend more of the time answering your questions. So broadly speaking, I think if you look at the results, they're a good set of results. We're very proud of them. It represents an important point to tell us where we are in the journey. What are the key takeaways? Key takeaways is a good rebound from, as Chee Koon says, very difficult 2020, where we were in the midst of dealing with a very dark period caused by COVID. We were able to demonstrate good results in turning around operations in two of our core sectors. Number one, retail, and number two, hospitality, and more specifically, long stay lodging on the escort side of things. And we would like to hope and believe that the worst is behind us. So we're still in recovery mode, but the financial results tells us that we have turned the darkest part of the COVID situation. If I look at the profit numbers, 1.3 billion, of which 1.1 billion was cash. So that also says that we are running a business that is able to generate high quality income. Only a relatively small percentage of that PATMI comes from fair value gains. Most of it comes from recurring operating income, as well as a very robust ability to recycle capital and generate good, healthy portfolio gains, which again puts us in position to pay a sustainable dividend to shareholders. So that part also is very instructive to us in telling us how the business can continue to sustainably deliver returns to shareholders. So that part is important. Where we believe we are still the unfinished article is when you look at the proportion of that cash profit that comes from the fund management and fee income business. That proportion is still relatively small. If I look at the contribution to operating PATMI that comes from our fee income business, it's roughly about 40%. And so it tells us that we are still early in our journey to becoming a leading REIM, where we can then point to the majority of our cash profit coming from the fee part of the business. Fee part business meaning REITs, private equity, as well as lodging management. And this is where we want to focus on execution in the next 2 years, 3 years, in really building that part of that business up so that we can then continue to rely on our fee income to generate the majority of our cash profit. And then that will tell us that we are in position as a leading REIM and be able to call ourselves that. Until such time, I think the balance sheet will continue to play an important role for us in contributing to the bottom line through capital recycling, through continuing to incubate assets that are not quite ready to be converted into FUM. These are going to continue to be important contributors in the next couple of years. So we are asking for your patience. Please bear with us. We are very mindful about what we need to do. But again, this is the early days in a journey that takes us to hopefully becoming a leading REIM, if not the leading REIM in Asia Pacific. So I think that hopefully gives you some color about how we see our financials, where the cash profit is coming from, what we need to do to continue to grow or change the complexion of that cash profit such that we become a proper REIM in our own eyes and in the eyes of our shareholders. Why don't I turn it back to David to moderate us through many of your questions which are coming in fast and furious. So thank you, Dave.
Thank you, Andrew. Thank you, Andrew. Chee Koon, you started in September 21. It's about what, 3 plus 5, 7 months only. And very creditable figures, creditable first set of financials you got on what you have, Andrew has outlined in just 7 months. CLI delivered a total profit after tax and minority interest, PATMI, at 1.35 billion. Reversing a net loss of 559 million in FY 2020. So this was mainly, I think, driven by higher fee income from fund, as you said, management and lodging management businesses, and improved performance from CLI's investment properties portfolio. So you generated healthy operating cash flow of 667 million. That's correct, isn't it? And coupled with the strengthening of cash profit, CLI propose a shareholder dividend of 15 Singapore cents per share FY 2021. Your share price has actually, within the last 7 months, has jumped from about $2.95 to $4.04 today. Very creditable, but we're not going to stop there. We shareholders want it to be maybe double. So we are hoping that this would be the trend. Now that we've got COVID slowly getting out of the way and borders opening, so let me look at together with you the expansion plans. CapitaLand Investment CLI expansion with the relaxation of COVID mask mandates in Singapore, Europe, and the US. CLI's lodging management business looks poised for significant growth. So what are CLI's expansion plans in this segment? And secondly, how will CLI fund these expansion plans?
So, thank you, David. The team has worked very hard. So naturally, a lot of the hard work, good work goes to the team, for delivering a decent set of results for 2020-2021. And we're continuing to see good numbers, especially in the lodging sector. There are two parts to the lodging business. One is really the real estate side, which is through the REITs and the private equity. So most of the assets are in the REITs and the private equity funds. And this sector is really a sector that it's really not difficult to raise money, whether it's through the REITs to support its asset acquisition, or raise private equity funds to support the growth for many of the value-added products, especially during this phase of recovery. So in terms of providing funding to grow this sector, it's really not difficult. In terms of the lodging management, which is really the part of running the operations of running the Ascott brand, the Somerset brand, the Citadines brand, and more recently we launched the Life brand. During COVID period where borders were shut, naturally you see that the business was affected. And more significantly, you see the impact in Europe, especially because we took on leases. And when you don't have people staying on some of these properties and you continue to pay the leases, you see that the impact was quite severe. But I must say that the recovery in this sector has been very buoyant. In the last few months, as borders started to reopen, you see in Europe, our revenue per available unit is recovered so strongly that it's getting close to the pre-COVID-19 period. In China, we were doing very well, 80-90% occupancy until the recent COVID shutdown. But I must say that the business itself is very, very resilient. And our own sense is that the lodging management business, as the borders reopen, people are more comfortable to travel. That lodging management side will continue to grow from strength to strength. Yeah.
So Chikun, is this a DBS in the making?
Well, I think I want to say that our ambition for doing after the restructuring of a CLI business into an asset management business, we have a big ambition to be a player that can compete with the best asset managers in the world. That's the ambition, to be a globally competitive player, but it's going to take some time. Before we want to be competitive with the best in class in the world, I think that there's a lot of things we need to do to focus on Asia Pacific. It is an area where we have built up our track record, reputation. I think there are a lot more capabilities that we need to do apart from China and Singapore, where we are traditionally strong at. There's a lot more we need to do in India, a lot we need to do in Vietnam, Japan, Korea, and Australia. Make sure that we are very strong in these markets in the ability to find good deals, off-market deals, deals that are below replacement cost, ability to execute on these deals. If we focus our minds and our energy and our attention to deliver returns for whether it's our LP investors in our funds or the unit holders in our REITs, I think growing the AUM of the business will become a byproduct of what we do. I want to just reassure all of you here, we are not just going to pursue growth for growth's sake. I mean, if we are just going to grow AUM at all costs without regard to price, without regards to our ability to execute, I think that's a very dangerous thing, because we believe in building a business that's long-lasting, that can continue to grow enterprise value. And, for all the investors here, you all can sleep peacefully knowing that the company is well managed, and we're always thinking about things in terms of the long-term, making sure that it's sustainable. It is sustainable. Thank you.
So you do have a dream, Chico. Then what can dash this dream? Is it China? Let me. How does this impact? Many countries have moved past COVID-19 lockdowns and large-scale testing. And in contrast, China still adheres to a strict zero COVID-19 strategy. The current lockdown in Shanghai is a good example of this. So, whilst you have this optimism and this dream to really grow carefully and steadily, what can upstage your dream? And is it how does this impact CLI's growth plans in China? And secondly, how does CLI mitigate risks in this hyper unpredictable environment in China?
China is the biggest and I would say the most important market to us at this point in time. We have boots on the ground. The reputation is there. And last year, some of you may remember, we made a major breakthrough in terms of opening up access to raising money from domestic investors. We recapitalized our Raffles City portfolio. It's a $50 billion portfolio where we brought in Ping An, and they invested 35 billion renminbi into the Raffles City portfolio, allowing us to unlock value and allowing us to continue to manage and collect fees for managing the portfolio. So China is important and will continue to stay important. In terms of the COVID, my own view is this: I think every single country will need to go through its wave. Some countries went through a very sharp wave, of infections and then coming off, and then life getting back to normal. Singapore took a bit of a longer time where we, have a bigger plateau, but we took a longer time before we can get to this period of openness. I think China went through a very sharp period of initial stage of infections, and then it got clamped down. And for the last 2 years, when everybody was fighting COVID, the whole economy was humming along. People were buying homes, people were shopping, deals were being done. So I think this COVID recovery period is something that China will need to do it. We have to trust the Chinese government in terms of how they see the situation, because it's the access to the vaccine, the availability of the mRNA vaccine in China. And I think it's unfortunate today that China still has a large number of elderly that are not vaccinated. And that's making it difficult, I believe, from the authorities' point of view to allow them to adopt more, more relaxed strategy towards managing COVID. So I think they are doing this with the mind of the safety and the well-being of the people, of the Chinese people. Of course, there will be economic impact. I think the government has put in place measures, tax incentive scheme to help the companies along. And I think we need to work very closely with them to deal with them. Andrew and I, we spend time talking to our colleagues in China to see what are the things we can be doing, whether it's helping some of our colleagues, in Shanghai especially, to even get access to food or that. So I must say that indeed some of the conditions are a bit challenging, but I'm confident that the whole market will recover. In fact, because of the situation in China, it's not just a COVID situation. It's because of the 3 red lines, the tightening of the banking situation in China. I must say that in the last 1 to 2 years, we are starting to see opportunities that we have never seen before. That's being surfaced to us, assets or land that I would say are pretty interesting prices. And you should allow us to totally capitalize on some of the opportunities and further build our track record in China.
The Ukraine war is likely to prolong, and economies will feel the pinch. I wonder how that would impact on your, prospect, your optimism.
Immediate impact is will be more in terms of the energy prices. We see that translating into higher utilities prices for the properties, especially in some of the European countries, particularly Germany. Of course, in Singapore and around the world, we are starting to see even our household level utilities prices are all going up. So that's the immediate impact. To be fair, we are monitoring the situation very clearly. The stock market is still very buoyant. The market is still flush with liquidity. People are still doing deals. I've been on the road, I've been in Europe, in the US, in Australia, in Japan recently. People are still taking, still need to allocate, still in the mood to invest. But people are still generally getting a bit more careful around making investment positions, big investments in Europe, because they are not sure how extensive the Ukraine war would spill over to other parts of Europe at this point in time. But people still have the appetite to continue to invest.
Yes, I guess you will make your assessment as you go along. But let me move on to the portfolio gain. CLI reported a portfolio of 535% compared to 1 year ago. It is also noted that CLI recorded a significant impairment in FY 2020 and a subsequent revaluation in FY 2021. So to what extent does the accounting impairment and the revaluation of CLI assets contribute to CLI's 535% portfolio gain? Is this for Andrew?
Yep, I think it is. Thank you, David. I would say that the two events are actually quite separate. The impairment in 2020 was largely driven by COVID, and then the subsequent revaluation, again, was a reflection of the improved operating environment that we spoke of. And therefore, the independent valuers who looked at the portfolio said, okay, given the improved operating environment, we will take the valuation back up slightly. So that's a COVID-related event, the impairment and the subsequent revaluation of the portfolio. In terms of the portfolio gain, it is a function of not being able to recycle very much in 2020, given COVID. It was a very quiet year. I think we barely broke 3 billion, and we got it done, I think, in December when CLCT acquired some business parks from us. But what happened in 2021 with the reopening of markets and a much more normalized capital recycling environment, in a way, we had to make up for lost time, and we were able to generate capital recycling, I think, in excess of about 13 billion, if I'm not mistaken, in gross value terms. This amount generated largely by 3 transactions. By far the largest was, as Chee Koon mentioned, the sell down of our Raffles City portfolio to Ping An. That was almost 10 billion of gross value. The second one was the divestment of our non-core retail portfolio in Japan. And then the third one was the sale of Galaxis to AREIT. So these 3 transactions largely accounted for most of the capital recycling in 21, and all 3 of them were done at a very healthy gain to fair value. And that really enabled us to generate a healthy portfolio gain off the back of a very quiet year in 2020, which was due to COVID. So the 535% of increase in portfolio gain pops out, but if you think about where it was in terms of a very low base in 2020, that should explain why that number is so large, and also compounded by the fact that we had a very active 2021, anchored by 3 sizable transactions, most of which was underpinned by the Ping An sell down. So it was a very good year for us in capital recycling. I don't think we will replicate that, given that the Ping An transaction was the product of many years of patiently building up the portfolio to a point where we could bring in a strategic investor in Ping An in China. So we will continue to recycle what's left of the balance sheet. We have very definitive plans in place this year, and the idea is to continue that momentum. Although it's unlikely we'll get to 13 billion in 22.
So that level of portfolio gain is not sustainable.
We did 13%. Our average is around 8 to 10%. So it was higher, but I wouldn't say it was a phenomenally higher.
Phenomenally higher. Let me move on to interest rates. While 63% of CLI's outstanding debt has a fixed debt rate, the remaining is floating. Analysts are forecasting that the US Fed's funds rate may reach 2% by the end of this year. So the question is, how would higher interest rates impact CLI's current implied interest cost of 2.7% and interest coverage?
Yeah, I guess this one's to me as well. Good question. I think interest rates are probably occupying all CFOs' minds these days. We have the benefit of a good credit position. And I think here is a situation where you have to deal with higher base rates. Everyone has to deal with higher base rates. What is going to be important is to be able to manage your credit spread. Increasingly important, because you want to manage that overall cost of debt down. So elements such as ensuring that you have high quality cash flow based on good operating recurring income, a strong balance sheet based on your robust net debt to equity, the ability to service your debt measured by metrics such as interest coverage. So this is where I think all three of these things we have to keep an eye on, so that when we approach our lenders, they can rest assured that the ability to service that debt, our credit position, our credit profiling, our credit pricing remains as tight as we can manage it. And that helps us manage the overall cost of debt. So it goes back to a relative position. And as long as we're on a relative basis, we can demonstrate competitiveness in acquiring funding, whether it is debt or equity, then it puts us in a relative position to compete effectively to grow our portfolio and acquire assets. I think no question, you can't run away from the fact that rates are going up. So there is a secular issue we have to deal with. That goes back to making sure we invest in good quality assets. They allow us to deliver rental reversion, keep occupancies high, maintain a good spread to the cost of funding. Otherwise, that cost of that gap will narrow, and we'll find ourselves in trouble with stranded assets. So it's multiple facets. I'm sure all CFOs are dealing with this, and I think for us it's very clear. Keep the balance sheet strong, keep your recurring income high quality, so that your lenders are reassured, give you good pricing, minimize that overall cost of debt. And on the top line, you make sure you invest properly so that your assets continue to deliver good rental growth, and you can manage that spread to your cost of funding, and therefore deliver good returns to shareholders. So,
Gentlemen, you've got a return on equity is 8.7 and earnings per share 26. Return on equity, gentlemen, is 8.7, earning per share 26 cents. As you know, number of your investors actually depend on dividends. And I've been asked to ask this. Dividend per share is pretty good, 15 cents. Can they be optimistic of a higher dividend return? From what you have said, they can be, I think.
Thanks. This is always this question always comes up. I mean, as much as possible, I think that we have a dividend policy. I think that's been articulated quite clearly. We want to stick by that, and as much as possible, I want to assure all the investors, this vehicle that we are creating is going to be able to generate cash quite richly, and we want to be responsible in how we use the cash. If we can find better ways to invest and deliver better returns, I think that's our priority. But what we want to do is that at least we want to be able to deliver the basic promise in terms of the dividend that we can give the shareholders. As we understand that some of you are invested with us for as a dividend income to fund some of your other needs as well. Yeah.
Thank you for your assurance, Chee Koon. We will now move on to live Q&A. Can I have the first question? For the lodging business, ART and Escort will jointly develop PBSA in South Carolina. Why was this not undertaken with CLD? How should we view development by other REITs with CLI or CLD?
So, in the original services agreement between CLI and CLD, we do give the first right, of for any development projects to CLD. But CLD must have the development capability in a specific market, because development business is very local in nature. So I would say that today, at least from my understanding of CLD, I shouldn't be speaking on behalf of CLD. They are strong in China. They are strong in Singapore. They have a good track record in Vietnam. The other markets, I think they still need time to develop. And from CLI's perspective, we want to be able to, if we can talk to them as a first right, but they don't have the capability and they cannot offer the most competitive way to deliver the development projects for us, I think CLI has the flexibility to talk to other development manager. And in this case, in the US specifically, CLD has no development presence in the US, so it's an easy answer.
Thank you. Next question. Why is there such a high concentration in perpetual funds, 81% in financial year 2021? And could you explain the reason behind the increase in concentration? Does this give CLI higher resiliency? Andrew?
The answer to the second question is yes. It is we've learned that not all FUM is the same. And the fact that we have a very strong REIT franchise is very valuable to us, and I think increasingly valuable to our shareholders. And the reason that the REIT franchise capital that is managed through the REITs is valuable is because of this perpetual nature of the REIT. The REIT is an open-ended listed product, and by open-ended it means it has a perpetual life in theory. And therefore, the capital that we manage for on behalf of our unit holders, or our REIT managers manage on behalf of our REIT unit holders, is perpetual in nature. If you contrast that to a private equity fund, which typically has a life of, let's say, anywhere between 5 to 10 years, at the end of that period, you have to return the capital back to your investors and replace that with new third-party capital. So there's always this idea that you have to think ahead to the next vintage of your private equity product. The REITs do not have this problem. In fact, the REITs continue to grow organically. If we can continue to grow our REITs organically at 10%, that's a very stable, predictable, recurring fee income source that is easily communicated and understood by investors. And that is why a perpetual fund concentration, I think, is a very healthy thing to have. And we've started CLI, life as CLI, from a position of strength, where the bulk of our FUM is actually in perpetual funds. What we need to do now is to continue to grow organically that perpetual fund source, or if we have ideas, creative ideas in bringing new REITs to market, we certainly consider that. But we want to supplement and complement that with the ability to now introduce interesting private equity product with Simon and Patrick's through the leadership and experience that Simon and Patrick bring into PERE and PEAA.
Thank you. So what would drive CLI to compete against the big boys like Blackstone, Brooksfield, PGIM? Also, how would CLI be affected by the crowded private real estate space and ending of the cheap money in inverted commas era? Chico, you want to answer this?
I don't quite understand the first question. What would drive CLI to compete against the big boys? But let me try to attempt to answer. I think players like Blackstone and Brookfield, they have done very well in their respective area. Started off in the Americas area, a great franchise, big AUM, delivered very good returns for the LPs, and have now become a very global franchise. Although a large part of their business are still in US and in Europe. My view is that in Asia itself, the entire real estate investment management space is still relatively fragmented. There are no, I would say, very prominent investment manager that can easily raise money and be able to assess products in the various fragmented Asian markets easily and raise big pots of capital, which is why, we, given our track record, given our reputation, given our DNAs in Asia, we want to undertake this opportunity to really become the leading player in Asia Pac, at least in the next few years. That's going to be our primary focus.
Thank you. The next question is, the lodging business constituted 32% of real estate AUM, but only 10% of FUM. Why is there such a large difference in these two figures? Is it because lodging is more asset heavy?
Let me take this one, David. No, it's actually just the way we define AUM and FUM. For CLI, FUM is funds under management, which are parked under the REITs bucket and the private equity bucket. So fees earned by ART and any of the lodging private equity funds constitute part of FUM. The AUM that Kevin's team manages on the Ascot side, where we are managing third-party assets and earning a fee for operating these assets, that constitutes the AUM part. And that's why that AUM number is very large, because out of the 120,000 or so keys that Kevin has already signed and is operating, almost 2/3 or more, almost 80%, sorry, I should say, today is actually part of this managed business. So that's the AUM part. The rest of it that's owned by ART and owned by Ascot Growth Fund, and more recently, for example, our PBSA fund, SAVE, that is the FUM part of the lodging pie. So it's just a question of understanding the definition.
Thank you for that explanation. Can you share more on how the PEFM status in China is a game changer? How is it important?
It is a competitive advantage for a real estate investment manager to be able to secure the fund management license to be able to raise renminbi money. I think especially for CapitaLand, I mean, you look at the entire landscape around the world, there's an increasing tension, this one everybody knows, between China and the rest of the world. China is such a big market, deep market. I mean, it's probably the next biggest market after the US in terms of real estate exposure. So many of the foreign investors will want to continue to gain access to opportunity in the US. Similarly, China has huge amounts of the domestic LPs, from the pension funds, the state-owned enterprise related investment vehicles, the insurance money, and having the ability to get this license, being able to tap on the renminbi capital, will put CapitaLand in a very interesting position where we can tap onshore money and we can also tap offshore money, giving us flexibility to pursue core plus, including value add opportunities in China. And we can tap on using a lot more of third parties' capital to grow a much bigger franchise in China, thereby strengthening our competitiveness, allowing us to even attract more talents to want to join our franchise in China.
So CapitaLand does enjoy political capital.
I would say that we just keep focus on running the business. We are really not bothered by the politics of what's happening in the world. We are aware, we are careful, but our real focus is how do we find opportunities, how do we create value, how do we make money for the investors that trust us with their money, both on the listed side and unlisted side.
That again is very assuring. What is CLI's targeted business breakdown in percentage, fund management, investment holding, etc.?
Okay. So let's use percentage of contribution to profit. In 2021, our contribution from fund management to overall profit was around 18% to PATMI. We all agree that that's not the finished article. We want to grow that part, as I mentioned in my opening remarks. I think the target for us in the next 3 to 5 years is to get that much closer to, say, 40 to 50% of the overall profit contribution. Therefore, in the next 3 to 5 years, the balance sheet and the investment holding part of the business will continue to play an important role. We want to set targets that are achievable and meaningful at the same time. And I think growing the business from a 20% contribution to 40 to 50% contribution, which is similar to some of the very large REIMs out there who have chosen this type of model, is something that we can aspire to and seek to achieve in this time frame.
Thank you. You can see that the retail investors are posing quite a lot of interesting questions, Mr. CEO. For the lodging business, 15,000 units were signed and 8,200 units were opened. What is the difference between signings and openings? When does recurring fee income start and on what basis points? You want to take this here?
The recurring fee income really starts when the property becomes operational. From the point of time of signing to operational, there's these other fees that we collect as a company. It's called the technical consultancy fees, where we get involved in the design in terms of the layout So there are fees that are being paid, but those are more one-off fees. Recurring fees really only starts when the property turns operational. In terms of the basis points, I would say that in terms of the margins for the lodging business, is quite close to our fund management business. I think in terms of the basis points, we don't quite share the details, and I just want to say that in terms of the margins today, we are quite comparable to the fund management business.
Thank you.
Andrew, you have anything else to add?
Just to quickly add, David, I mean, I think it's very, to your point, very reassuring and lovely to see that so many questions about lodging. You know, when we hosted this, and when you hosted us last time, maybe lodging questions. If you had 5 minutes left, we would get a couple, right? And here we are seeing lodging start to form the basis of many investors' interest points. And I have to say that this is also similar to what we are getting from our institutional investor base and our brokerage partners who cover us, the research analysts who cover us. The message we wanted to send out at the time we listed CLI, again, a point of differentiation that we believed set us apart from other REIMs, to some of the other questions that were raised, is that we think lodging is an interesting differentiator for us. Not many other REIMs have a lodging management platform that can earn fee income in a similar way to fund management. And if you think about where we are in the lodging cycle, as Chee Koon mentioned, borders are opening up, people are traveling again, and they're looking for a safe place to stay for themselves, for business, and with their families when they travel. We would like to position the Ascott family of brands as a long stay platform that delivers on these things at a very good value.
Unique position for CLI, or are there no other competitors?
Hard to say there are no other competitors, but I would say in terms of breadth, in terms of market reach, in many of the cities and countries that people travel to for business and for leisure, it's hard pressed to find another operator with a similar footprint in long stay.
Unique in Asia.
Certainly unique in Asia.
Yes.
Absolutely.
Thank you. CLI aspires to become BX or BAM of our own. How long do you see it takes to get there? Do we have a roadmap?
Good question. The ambition is definitely a global one. If you ask me, I obviously would hope to be able to do this as quickly as I can, but I want to be realistic. It depends on the timing, depends on opportunity. There are things that we need to get right. There are things we need to execute. But you know, there are a few things I would just want to caution. Today, asset prices are generally at an all-time high across every single asset class. We are in an environment where interest rates are rising. So while we are pursuing capabilities and pursuing growth, we want to make sure that we do this responsibly and be careful where we choose to prioritize our growth, where we channel our resources. The idea is to get there. In terms of timing, all that, we have a board strategy session coming up at the end of May. I hope that by the time I can get the strategy endorsed by the board and I can share more, maybe at the second half of the year in terms of the timing and the roadmap. Okay.
We'll try and get an investor day going by then. All right. Thank you. So before we end the session, we have some polling questions for you to participate via Zoom. So please get ready to vote. Do you think CLI should look beyond real estate investment and other non-real estate businesses such as technologies, Tesla, for example? Question 2, as the world transits to COVID endemic, would CLI's shareholders prefer to attend AGM on-site in the near future? And thirdly, do you find this type of shareholders engagement session with SIAS and CLI useful? Can you please start voting? So, on the first question, it looks like the answer is no. That's almost
That's good to hear because that's definitely not, and we want to stay focused.
yes.
And I mean, there are many opportunities to make money, but not every single opportunity is suitable for CLI. We want to stay focused and make sure we deliver good money for our investors and in areas where we know how to make money.
Yes, almost 80% voted no. So there you are. They are very responsible shareholders. Number two, as the world transits to COVID endemic, the second question, whether AGM should be on site. I think many of them prefer on site. Nothing like chemistry. So that's, I think.
Maybe we should have clarified whether or not it comes with a $20 voucher for your lunch.
You've been giving good vouchers, 74%, yeah. But, I think they're all very interested in meeting you, asking the relevant questions. And nothing like meeting the horses in person, And that does tell them a lot. Number three, 98%. Do you find this type of shareholders engagement session with CRs and CLI useful? 98% yes. Many of you may be holding shares in other listed companies, and watch out, we are doing a lot of these. We've done about 120 over dialogue sessions, and we find it very useful, and shareholders want this. So your 98% saying yes is not a surprise to me, but this would be the modus operandi as we go forward. So 3 questions have been answered. It's been a very informative session this morning, Mr. CEO and Mr. CFO. Thank you for coming and facing the shareholders' questions very well. I'm sure you enjoyed the session, you got your answers, but AGM is coming soon, so you can meet them. It's going to be a virtual one this year. Probably next year, we all hope that we can meet in person. Thank you very much. You would like to say something, closing remarks?
No, just thank you. Stay well, stay safe. If there have any other suggestions on how we can do this better for subsequent CS dialogue, please feel free to give the feedback. And definitely we'll do our best to make sure that we improve in terms of the quality of the exchange, in terms of the type of issues that you want to know. Let us know so we can also be better prepared as well. Thank you.
Thank you, shareholders. Keep looking at your company, CLI, closely and keep engaging them. Thank you.